Hidden wealth begins when nobody is looking. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Most investors spend their days searching for the next big technology company, the next AI winner, or the next headline-making stock. But history tells us that some of the greatest wealth creators rarely dominate the headlines. They quietly benefit from everyday human behavior. Think about your own home. When someone builds a house, the first things people notice are the location, the design, and the price. Investors usually notice cement, steel, and real estate developers. Yet every completed home quietly creates demand for dozens of businesses that never appear in the spotlight. Bathrooms are one of those hidden opportunities. Every apartment, villa, hospital, hotel, office, and airport needs them. More importantly, bathrooms are no longer viewed as a basic necessity. Across India, changing lifestyles have transformed them into spaces that reflect comfort, hygiene, and personal taste. As aspirations rise, spending shifts from buying the cheapest product to buying the right product. That change is far more important than it first appears. When a necessity becomes an aspiration, companies serving that category often enjoy years of structural demand instead of one-time purchases. This is why experienced investors try to understand the ripple effects of long-term change rather than reacting only to today's headlines. Government investment in housing and urban infrastructure may begin with construction, but its economic impact spreads across paints, tiles, lighting, kitchens, and bathroom solutions. Some businesses simply participate in that ecosystem more effectively than others. The next question is obvious. If every company can manufacture bathroom products, why do only a few create lasting shareholder value? The answer is trust. Customers rarely know how ceramic is fired or how long a faucet cartridge will last. They rely on brands, recommendations from architects and builders, and past experience. Over time, trust becomes an economic asset that competitors cannot easily copy. This brings us to the company at the center of today's documentary Cera. The real question is not whether it sells sanitaryware. The real question is whether it has built a business capable of benefiting from India's long-term lifestyle transformation. We won't answer that question with excitement or speculation. We'll answer it by studying the business, the industry, the management, the numbers, the risks, and the valuation one layer at a time. Because the best investments don't begin with a stock chart. They begin with curiosity. Next chapter. Before we study the financial statements, let's step inside an Indian home and discover what Cera is actually selling and why it is much more than toilets and taps. Chapter 2: India's Bathroom Revolution. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Close your eyes and think about the bathrooms you remember from 20 years ago. They were built for utility. If the tap worked and the toilet flushed, the job was done. Today, walk into a newly built apartment, a premium hotel, or even a modern office, and you'll notice something very different. Bathrooms have become an extension of lifestyle. This shift tells us an important story about consumer behavior. As incomes rise, people don't just buy more, they buy better. They begin to value design, comfort, hygiene, and durability. Economists call this premiumization. In simple words, expectations grow faster than basic needs. Imagine a family building its dream home. They may negotiate hard on construction costs, but when it comes to the spaces they use every single day, they often prefer products that inspire confidence. A bathroom is no longer a hidden corner of the house. It has become part of the home's identity. That is where Cera's business model becomes more interesting than it first appears. The company is not trying to sell a single product. It is trying to participate in the complete bathroom journey from wash basins and sanitaryware to faucets, mirrors, accessories, and premium collections. The objective is to become the brand customers remember when they build, renovate, or upgrade their homes. Think about the last time you visited a beautifully designed hotel. Without realizing it, your expectations changed. The next time you renovate your own home, you naturally compare it with that experience. Consumer psychology quietly raises the standard, and businesses positioned around aspiration benefit from that change. Another important influence comes from professionals. Architects, interior designers, builders, and dealers often guide purchasing decisions long before the homeowner enters a showroom. A trusted recommendation can be more powerful than an expensive advertisement. That is why relationships and distribution become strategic assets rather than simple sales channels. Cera has invested in multiple customer-facing formats, allowing buyers to experience products instead of seeing them in a catalog. When customers interact with complete bathroom solutions, they are evaluating an experience, not just comparing prices. The lesson for investors is simple. Businesses rarely become exceptional by selling more products. They become exceptional when they occupy a meaningful place in the customer's mind. That emotional connection is difficult to measure, but over time, it can become one of the strongest competitive advantages. In the next chapter, we'll move beyond consumer behavior and explore the invisible strengths that separate an ordinary manufacturer from a business with a durable competitive moat. Chapter 3 Cera isn't selling toilets. It's selling confidence. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Let's ask a simple question. When someone buys a sanitaryware product, what are they actually purchasing? At first glance, the answer seems obvious: a toilet, a wash basin, or a faucet. But great businesses are built by understanding that customers rarely buy products alone. They buy outcomes. Imagine buying a drill machine. Nobody truly wants the drill. They want a perfectly placed hole in the wall. In the same way, homeowners are not searching for ceramic or chrome. They are searching for reliability, cleanliness, beauty, and peace of mind every single day. This idea is known as the jobs to be done framework. People hire a product to solve a problem in their lives. A bathroom must work flawlessly every morning, remain easy to clean, withstand years of use, and still look attractive when guests visit. The product's job is much bigger than its physical form. Now think about the stress involved in building a home. Hundreds of decisions compete for attention. In such situations, buyers naturally prefer brands that reduce uncertainty. A trusted name lowers the fear of making an expensive mistake. That confidence has real economic value. For companies like Cera, this changes the nature of competition. Winning is not only about offering the lowest price. It is about delivering a complete experience through product quality, design, dealer support, after-sales service, and consistent availability. Each positive interaction strengthens the customer's willingness to return and recommend the brand. Architects, interior designers, and builders also play an important role. Their reputation depends on recommending products that perform well over time. When professionals repeatedly choose the same brand, they create a cycle of trust that advertising alone cannot replicate. This is why investors should look beyond the factory. A competitive advantage is often invisible. It lives in customer memory, professional relationships, and the confidence that a purchase made today will still feel like the right decision years later. The most successful businesses understand a timeless principle. People may compare prices, but they remember experiences. When a company consistently delivers those experiences, it earns something far more valuable than a single sale. It earns loyalty. In the next chapter, we'll examine whether Cera has built an invisible moat that protects its business from competition and allows it to compound value over the long term. Chapter 4: The Invisible Moat. Why some businesses are hard to replace. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Imagine two restaurants serving identical food at the same price. One is always full, while the other struggles to attract customers. The difference is rarely the recipe alone. It is trust, reputation, and consistency. The same principle applies to businesses. In investing, This lasting competitive advantage is often called an economic moat. Just as a moat protected a castle from invaders, a business moat makes it difficult for competitors to steal customers and profits. The strongest moats are usually invisible. They are built over years and cannot be copied overnight. For Cera, the moat is not a single patent or one best-selling product. It is a combination of brand recognition, product quality, a wide dealer network, relationships with architects and builders, and the confidence customers place in the company after repeated positive experiences. Think about how a family renovates a home. They may compare several brands online, but the final decision is often influenced by a trusted dealer, an architect's recommendation, or a friend's experience. Every satisfied customer becomes an unpaid ambassador for the brand, creating a cycle that strengthens itself over time. Distribution is another important layer of this moat. Even an excellent product cannot generate sales if it is unavailable when customers need it. A company that consistently supplies dealers, supports retailers, and offers a broad product portfolio becomes easier to do business with. That convenience creates loyalty throughout the value chain. There is also a psychological advantage. When homeowners are making a once-in-a-decade purchase, many prefer a familiar brand over an unknown alternative to reduce the risk of regret. This behavior may seem simple, but it gives established companies pricing power and resilience. Of course, no moat is permanent. Competitors can improve, consumer tastes can evolve, and technology can change industries. Great management teams therefore keep reinvesting in quality, innovation, design, and customer relationships instead of assuming yesterday's success will guarantee tomorrow's growth. For investors, the lesson is clear. A strong moat does not eliminate competition, it makes winning against that business more expensive, more time-consuming, and less predictable. In the next chapter, we'll go inside the manufacturing ecosystem to understand how operational excellence supports Cera's promise of consistency and quality. Chapter 5: The Factory Nobody Sees, where quality becomes a habit. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. When investors hear the word manufacturing, they often imagine machines, smokestacks, and production lines. But the best factories are not defined by the number of machines they own. They are defined by the consistency of the products they deliver every single day. Imagine two chefs following the same recipe. One serves an excellent meal once in a while the other delivers the same taste every day for years. Customers return to the second chef because consistency builds trust. Manufacturing works the same way. For a brand like Cera, quality is not created at the showroom. It is created long before the customer sees the finished product. Every stage from sourcing raw materials and precision manufacturing to quality checks and packaging contributes to the experience the customer eventually takes home. As production scales, disciplined processes become more valuable than individual effort. Automation, standard operating procedures, and continuous quality improvement help reduce errors, improve efficiency, and maintain uniform standards across thousands of products. The objective is not simply to make more units, it is to make every unit dependable. This is where the idea of operating leverage becomes important. Imagine a cinema hall with 300 seats. Whether 150 people attend or all 300 seats are filled, many costs such as rent, staff, and maintenance remain largely unchanged. As more seats are occupied, those fixed costs are spread across a larger number of tickets. A well-run factory can benefit in a similar way. When demand grows without a proportional rise in fixed costs, profitability can improve faster than revenue. Operational excellence also strengthens the brand. Dealers prefer suppliers that deliver on time. Builders value predictable quality. Ments may never become headlines, but together they build a reputation that compounds over decades. Operational excellence also strengthens the brand. Dealers prefer suppliers that deliver on time. Builders value predictable quality. Customers appreciate products that last for years without creating maintenance problems. Small operational improvements may never become headlines, but together they build a reputation that compounds over decades. At the same time, efficient manufacturing is never a destination. Consumer preferences evolve, technology improves, and competitors continue investing. Companies that keep modernizing their processes are better prepared to meet changing expectations without compromising quality. For long-term investors, factories should not be viewed as collections of machines. They are systems that convert raw materials into customer trust. When those systems are managed well, manufacturing becomes a competitive advantage rather than just a production activity. In the next chapter, we'll step beyond the factory gates and examine the size of the opportunity itself. After all, even the best business needs a market large enough to support years of future growth. Chapter 6: The market is bigger than the company. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. A wonderful business can still become a disappointing investment if it has no room left to grow. That is why experienced investors spend as much time studying the size of the opportunity as they do studying the company itself. Even the strongest management team cannot grow forever in a market that has reached its limits. Imagine opening the best restaurant in a village with only a few hundred residents. You may earn a good reputation, but your growth will eventually slow because the market itself is small. Now imagine offering the same quality in a fast-growing city where new families arrive every day. The business suddenly has far more possibilities. The difference is not the chef, it is the size of the market. For companies like Cera, the opportunity extends far beyond selling products to people building a new house. Demand also comes from home renovations, commercial buildings, hotels, hospitals, schools, offices, and public infrastructure. Every upgrade, replacement, or expansion creates another opportunity to serve customers. One of the biggest long-term trends is premiumization. As household incomes improve, many consumers gradually move from basic products to solutions that offer better design, durability, and aesthetics. This shift often happens slowly, but over many years, it can reshape an entire industry. Urbanization adds another layer of demand. Growing cities require new homes, better infrastructure, and modern commercial spaces. At the same time, India's existing housing stock continues to age, creating a replacement cycle as older bathrooms are renovated to meet changing lifestyles and expectations. An important lesson for investors is that great businesses often grow through multiple demand drivers at the same time. New construction brings first-time buyers. Renovation creates repeat demand. Commercial projects expand the customer base. Premium products improve average selling prices. Together, these forces can reinforce one another instead of acting independently. Of course, large markets also attract competition. A growing opportunity invites new entrants, price pressure, and innovation. Companies must therefore continue strengthening their brand, distribution, and execution to convert market potential into profitable growth. When evaluating any business, ask two simple questions. First, is the market large enough to support many more years of expansion? Second, does the company possess the capabilities required to capture a meaningful share of that opportunity? Long-term wealth is often created when the answer to both questions is yes. In the next chapter, we move from the market to the people making the most important decisions. We'll examine management, capital allocation, and why leadership quality can determine whether a good business becomes a great investment. Chapter 7: The people allocating your money. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Imagine two families with exactly the same annual income. One spends every rupee without a plan, while the other saves wisely, avoids unnecessary debt, and invests for the future. 10 years later, their financial positions can be dramatically different. Companies operate in much the same way. What separates an average business from a long-term wealth creator is often not just what it earns, but how its leaders allocate those earnings. Great management teams think like owners rather than caretakers. Every rupee of profit presents a choice. Should it be invested in expanding capacity, used to launch new products, returned to shareholders, or simply preserved to strengthen the balance sheet? Capital allocation is the discipline of making those decisions wisely. Think of a cricket captain. Every player may be talented, but the captain decides who bowls first, who fields where and when to attack or defend. A brilliant strategy can elevate an average team, while poor decisions can waste extraordinary talent. Leadership in business works in a similar way. Investors therefore study more than quarterly profits. They observe whether management communicates honestly during good times and difficult periods alike. They look for consistency between promises and actions, discipline in spending, and a willingness to focus on long-term value rather than chasing short-term headlines. Another important quality is governance. Strong governance means decisions are made transparently, minority shareholders are treated fairly, and the interests of management remain aligned with those of long-term investors. Trust built over many years can become one of the company's most valuable assets. Markets also reward leaders who adapt. Consumer preferences evolve, technology changes, and competition never stands still. Management teams that continue learning, investing, and improving are usually better positioned to navigate uncertainty than those who rely only on past success. One useful mental model is to think of management as the gardener of a large orchard. Planting trees is only the beginning. They must nurture healthy branches, remove what no longer works, and patiently invest today for fruit that may appear years later. Sustainable businesses are rarely built through dramatic decisions. They are built through hundreds of disciplined choices repeated over time. When analyzing any company, ask yourself a simple question. If this management team were responsible for your family's savings instead of a listed company, would you trust them to make thoughtful, patient decisions? That question often reveals more than any spreadsheet. In the next chapter, we'll turn from leadership to the financial statements and learn how to read numbers the way long-term investors do, looking beyond profits to understand the true economic strength of the business. Chapter 8, Reading Numbers Like a Long-Term Investor. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Every listed company publishes pages of financial statements. To many people, they look like rows of confusing numbers. Yet for a long-term investor, these numbers tell a story. They reveal how efficiently a business is growing, how resilient it is during difficult periods, and whether its success is supported by real cash rather than optimistic headlines. Imagine you on a small neighborhood grocery store. At the end of the month, you would naturally ask a few questions. How much did the shop sell? How much money remained after paying expenses? Did customers actually pay? Or are they still promising to pay later? And after all of that, how much cash is left in the drawer? Financial statements answer these same questions for large companies. The income statement begins with revenue. Revenue is simply the money earned from selling products or services. But high revenue alone is never enough. A business that earns 100 crore rupees in sales but spends almost everything to generate those sales may not create much value for shareholders. That is why investors also focus on profit margins, the portion of each rupee of revenue that ultimately becomes profit. Next comes cash flow. Profit is based on accounting rules, while cash flow reflects the movement of real money. A company can report healthy profits on paper, but if cash is not reaching the bank account, investors should ask why. Healthy businesses generally convert a meaningful share of their profits into cash that can be reinvested, used to reduce debt, or returned to shareholders. Another useful measure is return on capital employed, or ROCE. Think of a farmer with two equally sized fields. If one field consistently produces a larger harvest using the same land and equipment, it is being used more efficiently. ROCE measures a similar idea in business. It shows how effectively management turns invested capital into operating profits. The balance sheet provides another important clue. It shows what the company owns, what it owes, and how strong its financial foundation is. Businesses carrying manageable debt usually have greater flexibility during uncertain periods because they are not forced to devote a large share of their earnings to interest payments. No single financial ratio can tell the entire story. Strong investors look for consistency rather than perfection. They ask whether revenue, profitability, cash generation, and capital efficiency are moving in the right direction over many years instead of reacting to one unusually good or bad quarter. When studying Cera or any company, the objective is not to memorize ratios. The objective is to understand whether the numbers support the story management is telling. When business quality and financial quality reinforce each other, confidence in the long-term investment case becomes much stronger. In the next chapter, we'll move from business performance to market valuation and answer a timeless investing question. Even a wonderful company can become a poor investment if you pay too high a price. Chapter 9: Price is what you pay, value is what you get. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Imagine walking into a showroom and seeing two watches. One costs 5,000 rupees and the other 50,000 rupees. Without understanding the quality, craftsmanship, or durability, the price alone tells you very little. Investing works the same way. A stock is not expensive simply because its share price is high, and it is not cheap simply because its share price is low. The real question is whether the price you pay is justified by the quality and future earning power of the business. Great investors spend less time asking, "What is today's price?" and more time asking, "What am I getting in return for that price?" One of the most common valuation measures is the price-to-earnings ratio, or PE. Imagine buying a small shop that earns 10 lakh rupees every year. If someone asks 1 crore rupees for that shop, you are effectively paying 10 years' worth of current annual earnings. The PE ratio expresses a similar relationship between a company's market value and its profits. A higher PE can sometimes reflect high expectations for future growth, while a lower PE may signal lower expectations or hidden problems. Context matters more than the number itself. Growth is equally important. Suppose two businesses trade at similar valuations, but one consistently expands faster while maintaining healthy profitability. Investors may willingly pay more for that business because future earnings could justify today's premium. This is why many analysts also compare valuation with growth instead of looking at PE in isolation. Another useful perspective is the price-to-book ratio. Think of buying a house. You would naturally compare the asking price with the value of the land and the building. In business, book value represents the accounting value of the company's net assets. While this measure is more useful in some industries than others, it provides another lens through which investors can judge valuation. Some professionals also use enterprise value and EV/EBITDA because these measures consider both the value of the company and its financing structure. You don't need to memorize the formula. The key idea is that experienced investors often compare businesses using multiple valuation methods rather than relying on a single ratio. Perhaps the most important concept of all is the margin of safety. Imagine crossing a bridge that can safely carry 20 tons. Driving a 10-ton truck across it leaves a comfortable cushion if conditions change unexpectedly. Investing follows the same principle. Buying a quality business at a reasonable valuation provides room for error if growth slows or markets become volatile. Valuation is therefore not about finding the cheapest company. It is about balancing business quality, growth potential, and the price being paid. A wonderful company purchased at an unrealistic valuation can deliver disappointing returns, while a good business bought sensibly can reward patient investors over time. When evaluating Cera or any business, the objective is to decide whether today's expectations already reflect tomorrow's opportunities. That balance between optimism and discipline is where thoughtful investing begins. In the next chapter, we leave financial statements behind and step into the world of charts, not to predict the future, but to understand market psychology and how investors collectively vote on a business every trading day. Chapter 10: What Charts Really Measure. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Many people believe stock charts are mysterious tools that predict the future. In reality, a chart does something much simpler and much more useful. It records every buying and selling decision made by thousands of market participants. In other words, a chart is a visual record of collective human behavior. Imagine an auction where hundreds of people bid for a rare painting. The painting itself never changes during the auction, but its price moves because opinions change. The stock market works in much the same way. Every trade reflects a different expectation about the future, and charts capture that changing balance between optimism and caution. Benjamin Graham once described the market as a voting machine in the short term and a weighing machine in the long term. Day by day, prices are influenced by emotion, news, and expectations. Over longer periods, they tend to reflect the economic strength of the underlying business. Understanding this distinction helps investors avoid reacting emotionally to every market movement. One of the most important ideas visible on a chart is trend. A trend is simply the market's direction over time. Rather than focusing on isolated daily fluctuations, experienced investors ask whether confidence in the business appears to be strengthening or weakening over months and years. Volume adds another layer of insight. Imagine a political rally attended by only 20 people compared with one attended by 20,000. Both events happened, but one clearly carries greater significance. In markets, unusually high trading activity often suggests that a larger group of participants is paying attention. By itself, volume proves nothing, but alongside price, it can reveal periods of unusually strong interest. Relative strength is another useful concept. During difficult market conditions, some businesses decline less than others, while in stronger markets they recover more quickly. This resilience often encourages investors to study the underlying business more closely. It does not guarantee future performance, but it can highlight where confidence is building. Perhaps the greatest mistake investors make is treating charts and business analysis as opposing philosophies. They're not competitors. They answer different questions. Financial statements explain what a company has achieved. Charts illustrate how the market is responding to that information. Looking at both together provides a more balanced perspective than relying on either one alone. A chart should never replace thoughtful research, and research should never ignore market behavior. The strongest investment decisions often emerge when improving business fundamentals are accompanied by steadily improving investor confidence. In the next chapter, we'll explore how long-term institutional investors approach the market differently from short-term traders, and why patient accumulation often leaves subtle clues before the wider market notices. Chapter 11: Why Institutions Never Hurry. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Imagine you want to buy a cup of tea. You can walk into a cafe, pay, and leave within minutes. Now imagine buying an entire tea plantation. You cannot make that purchase in a single afternoon without dramatically affecting the price. The same difference exists between individual investors and large institutions. Mutual funds, insurance companies, and other large investors often manage thousands of crores. If they decide to invest in a business, they cannot simply press the buy button once. Purchasing such a large quantity of shares too quickly could push the price sharply higher, making every additional purchase more expensive. For that reason, institutional investing is usually a process rather than an event. Decisions are supported by research, discussions with management, industry analysis, and detailed financial modeling. Even after deciding to invest, buying is often spread over days, weeks, or even months. This patient approach leaves an important lesson for individual investors. Long-term wealth is rarely created by reacting to every market headline. It is created by identifying businesses with durable potential and allowing time for the investment thesis to play out. Market behavior sometimes reflects this gradual change in conviction. Instead of dramatic one-day moves, investors may notice periods where confidence appears to strengthen steadily. Improving participation, resilient price behavior, and sustained interest can suggest that more market participants are beginning to recognize the business. None of these observations prove institutional buying on their own, but they can encourage investors to study the underlying business more carefully. Think of an iceberg. Only a small portion is visible above the water, while the larger structure remains hidden beneath the surface. Financial results, strategic decisions, and changing investor expectations often develop quietly before they become obvious to everyone. Successful investing frequently involves recognizing those gradual shifts without assuming certainty. It is equally important to avoid a common mistake. Following institutions blindly is not a strategy. Large investors can be wrong, and their objectives may differ from yours. Their activity should never replace independent research. Instead, it can serve as one additional piece of evidence within a broader investment framework. The real advantage individual investors possess is patience. Unlike many professionals, they're not judged every quarter by clients or performance rankings. They can wait while a well-researched investment matures over many years. When business quality, disciplined management, healthy financials, and improving market confidence begin moving in the same direction, the probability of a durable long-term story becomes more interesting. That combination deserves attention not because it guarantees success, but because it reflects alignment across multiple dimensions of the investment case. In the next chapter, we'll examine the long-term growth engines that could influence Cera's future and explore how enduring trends can shape shareholder returns over the coming years. Chapter 12: 5 engines that could drive the next decade. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. By now we've explored the business, its competitive position, its management, its financials, and the way the market looks at it. The next question every long-term investor should ask is simple. What could make this business meaningfully larger 10 years from now? Think of an aircraft preparing for takeoff. One engine is enough to keep it moving on the runway, but long-distance flight depends on several engines working together. Businesses also create durable growth when multiple drivers reinforce each other instead of relying on a single opportunity. Engine 1: Rising aspirations. As household incomes improve, customers increasingly value design, hygiene, durability, and convenience. This gradual shift toward better products can support long-term demand for established brands that consistently deliver quality. Engine 2: Renovation and replacement. Growth does not depend only on new homes. Bathrooms, fittings, and interiors are periodically upgraded as lifestyles change. This replacement cycle creates recurring demand even when new construction slows. Engine 3: Urban development. Expanding cities require homes, offices, hospitals, hotels, schools, and public infrastructure. Each completed project creates demand for a wide range of bathroom solutions, widening the addressable opportunity over time. Engine 4: Product expansion and distribution. Companies that broaden their product portfolio while strengthening dealer relationships can serve more customer needs through the same network. Expanding customer relationships is often more efficient than acquiring entirely new ones. Engine 5: Operational excellence. Better manufacturing, disciplined execution, and continuous improvement can enhance efficiency and customer satisfaction. Small gains repeated consistently over many years often produce surprisingly large outcomes. No growth story is automatic. These engines only create shareholder value when management allocates capital wisely, protects the brand, and adapts to changing customer preferences. Trends create opportunities, but execution determines who benefits from them. One useful mental model is planting an orchard. Different trees mature at different speeds. Some begin producing fruit early, while others take years before delivering meaningful harvests. Patient investors understand that long-term compounding often comes from several small growth drivers working together rather than one dramatic breakthrough. When multiple structural trends, disciplined management, and a strong business model begin reinforcing one another, investors should pay attention. Not because success is guaranteed, but because the probability of sustainable growth becomes more compelling. In the next chapter, we'll examine the other side of the story. Every investment carries uncertainty, and understanding the risks is just as important as understanding the opportunities. Chapter 13: Every great business has risks. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Up to this point, we've explored why Cera could be an attractive business. But disciplined investing requires something equally important: understanding what could go wrong. The goal is not to find a perfect company. The goal is to identify the risks, judge whether they are manageable, and decide whether the potential reward justifies accepting them. Imagine a skilled ship captain preparing for a long voyage. Before leaving the harbor, the captain studies weather forecasts, fuel levels, alternate routes, and emergency plans. That preparation does not guarantee a smooth journey, but it greatly improves the chances of reaching the destination safely. Investing follows the same principle. The first risk is the housing and construction cycle. Demand for bathroom products is closely linked to residential and commercial development. If economic activity slows, project launches are delayed, or consumers postpone renovations, demand can weaken for a period of time. The second risk comes from raw material and input costs. When the prices of energy, ceramics, metals, or logistics rise sharply, manufacturers may face pressure on profitability. Passing higher costs on to customers is not always immediate or easy, especially in competitive markets. A third challenge is competition. Every attractive industry encourages existing players to innovate and new participants to enter. Companies that stop investing in design, product quality, customer experience, or distribution can gradually lose their competitive edge. Consumer preferences also evolve. Styles, colors, technology, and expectations change over time. Businesses that fail to understand changing tastes risk becoming less relevant, even if they were successful in the past. Another risk is execution. Expansion plans, new product launches, and investments in manufacturing all require disciplined implementation. Even a strong strategy can disappoint if execution falls short. Valuation deserves attention as well. A wonderful business purchased at unrealistic expectations can produce disappointing returns if future growth fails to match market optimism. Investors should always distinguish between admiring a company and overpaying for its shares. Finally, there's the risk we can never completely eliminate uncertainty. Economic shocks, policy changes, supply chain disruptions, and unexpected global events can affect even the best managed companies. Successful investors accept that uncertainty is permanent. They prepare for it instead of pretending it does not exist. The encouraging news is that risks become easier to manage when they are recognized early. Diversification, patience, sensible position sizing, and continuous learning help investors navigate periods of uncertainty without abandoning a well-researched investment process. They can wait while a well-researched investment matures over many years. When business quality, disciplined management, healthy financials, and improving market confidence begin moving in the same direction, the probability of a durable long-term story becomes more interesting. That combination deserves attention not because it guarantees success, but because it reflects alignment across multiple dimensions of the investment case. In the next chapter, we'll examine the long-term growth engines that could influence Cera's future and explore how enduring trends can shape shareholder returns over the coming years. Chapter 12: 5 engines that could drive the next decade. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. By now we've explored the business, its competitive position, its management, its financials, and the way the market looks at it. The next question every long-term investor should ask is simple. What could make this business meaningfully larger 10 years from now? Think of an aircraft preparing for takeoff. One engine is enough to keep it moving on the runway, but long-distance flight depends on several engines working together. Businesses also create durable growth when multiple drivers reinforce each other instead of relying on a single opportunity. Engine 1. Rising aspirations. As household incomes improve, customers increasingly value design, hygiene, durability, and convenience. This gradual shift toward better products can support long-term demand for established brands that consistently deliver quality. Engine 2. Renovation and replacement. Growth does not depend only on new homes. Bathrooms, fittings, and interiors are periodically upgraded as lifestyles change. This replacement cycle creates recurring demand even when new construction slows. Engine 3. Urban development. Expanding cities require homes, offices, hospitals, hotels, schools, and public infrastructure. Each completed project creates demand for a wide range of bathroom solutions, widening the addressable opportunity over time. Engine 4. Product expansion and distribution. Companies that broaden their product portfolio while strengthening dealer relationships can serve more customer needs through the same network. Expanding customer relationships is often more efficient than acquiring entirely new ones. Engine 5. Operational excellence. Better manufacturing, disciplined execution, and continuous improvement can enhance efficiency and customer satisfaction. Small gains repeated consistently over many years often produce surprisingly large outcomes. No growth story is automatic. These engines only create shareholder value when management allocates capital wisely, protects the brand, and adapts to changing customer preferences. Trends create opportunities, but execution determines who benefits from them. One useful mental model is planting an orchard. Different trees mature at different speeds. Some begin producing fruit early, while others take years before delivering meaningful harvests. Patient investors understand that long-term compounding often comes from several small growth drivers working together rather than one dramatic breakthrough. When multiple structural trends, disciplined management, and a strong business model begin reinforcing one another, investors should pay attention. Not because success is guaranteed, but because the probability of sustainable growth becomes more compelling. In the next chapter, we'll examine the other side of the story. Every investment carries uncertainty, and understanding the risks is just as important as understanding the opportunities. Chapter 13. Every great business has risks. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. Up to this point, we've explored why Cera could be an attractive business. But disciplined investing requires something equally important: understanding what could go wrong. The goal is not to find a perfect company. The goal is to identify the risks, judge whether they are manageable, and decide whether the potential reward justifies accepting them. Imagine a skilled ship captain preparing for a long voyage. Before leaving the harbor, the captain studies weather forecasts, fuel levels, alternate routes, and emergency plans. That preparation does not guarantee a smooth journey, but it greatly improves the chances of reaching the destination safely. Investing follows the same principle. The first risk is the housing and construction cycle. Demand for bathroom products is closely linked to residential and commercial development. If economic activity slows, project launches are delayed, or consumers postpone renovations, demand can weaken for a period of time. The second risk comes from raw material and input costs. When the prices of energy, ceramics, metals, or logistics rise sharply, manufacturers may face pressure on profitability. Passing higher costs on to customers is not always immediate or easy, especially in competitive markets. A third challenge is competition. Every attractive industry encourages existing players to innovate and new participants to enter. Companies that stop investing in design, product quality, customer experience, or distribution can gradually lose their competitive edge. Consumer preferences also evolve. Styles, colors, technology, and expectations change over time. Businesses that fail to understand changing tastes risk becoming less relevant, even if they were successful in the past. Another risk is execution. Expansion plans, new product launches, and investments in manufacturing all require disciplined implementation. Even a strong strategy can disappoint if execution falls short. Valuation deserves attention as well. A wonderful business purchased at unrealistic expectations can produce disappointing returns if future growth fails to match market optimism. Investors should always distinguish between admiring a company and overpaying for its shares. Finally, there's the risk we can never completely eliminate uncertainty. Economic shocks, policy changes, supply chain disruptions, and unexpected global events can affect even the best managed companies. Successful investors accept that uncertainty is permanent. They prepare for it instead of pretending it does not exist. The encouraging news is that risks become easier to manage when they are recognized early. Diversification, patience, sensible position sizing, and continuous learning help investors navigate periods of uncertainty without abandoning a well-researched investment process. Every investment is a balance between opportunity and risk. Understanding both sides of the equation is what separates speculation from thoughtful investing. In the final chapter, we'll bring together everything we've learned and answer the most important question of all. What kind of business has Cera built? And how should a long-term investor think about it? Chapter 14, The Final Investment Thesis. Behind every stock is a business. Behind every business is a story. Welcome to Story Behind Stocks. We've now reached the end of our journey. We began with a simple question. Is Cera merely a manufacturer of bathroom products, or is it a business capable of creating long-term value? The answer does not lie in a single financial ratio, a chart pattern, or a headline. It emerges only after connecting every piece of the puzzle. Along the way, we explored how changing lifestyles, urbanization, and premiumization have expanded the opportunity for organized brands. We examined the importance of trust, distribution, manufacturing discipline, and customer experience. We looked at leadership, capital allocation, financial quality, valuation, market psychology, institutional behavior, and the risks that every investor must respect. No great investment is built on certainty. Investing is the art of making thoughtful decisions with incomplete information. The objective is not to predict the future perfectly, but to identify businesses that have the ability to adapt, compete, and create value over long periods of time. Imagine planting a banyan tree. In the early years, progress appears slow. The strongest growth happens beneath the surface as roots spread deep into the ground. Years later, those invisible foundations support a tree capable of standing through changing seasons. Many enduring businesses grow in a similar way. Their greatest strengths are often built quietly before they become obvious to the market. If Cera continues strengthening its brand, serving customers well, allocating capital responsibly, and adapting to changing consumer expectations, it has the opportunity to remain relevant in a market supported by long-term structural demand. At the same time, investors should continue monitoring execution, competition, valuation, and industry conditions rather than assuming today's trends will automatically continue forever. The most successful investors never fall in love with a stock. They remain committed to evidence. When new information changes the investment case, they are willing to update their conclusions with discipline instead of emotion. So, is Cera a good business? Based on the themes explored throughout this documentary, it displays many characteristics that long-term investors often admire. Whether it becomes a rewarding investment from today's valuation is a separate question, one that every investor must answer according to their own research, risk tolerance, and investment horizon. That distinction is perhaps the most important lesson of all. A great business and a great investment are not always the same thing. Business quality, future growth, and the price you pay must all work together before an investment truly becomes compelling. As always, this documentary is intended to help you think independently, not to tell you what to buy or sell. If this journey helped you understand the business behind the stock, then we've achieved our purpose. Because the best investments don't begin with a tip. They begin with curiosity. They grow through patience. And they are sustained by continuous learning. Thank you for listening Story Behind Stocks. If you enjoyed this documentary, consider subscribing for more deep dives into the businesses shaping India's future.